For over half a century, financial theory has been largely dominated by the principles of traditional finance, which rests on the assumption that investors are relational agents who make decisions based solely on logical evaluation of information. However, empirical observations increasingly suggest that investor behavior can deviate from these rational models, often under the influence of emotional and psychological states. Behavioral finance offers a framework that integrates these non-rational elements into the understanding of financial decision-making. Since Daniel Kahneman's Nobel Prize in 2002, this field has received growing academic recognition. Foundational models in finance, such as capital asset pricing model or CAPM, arbitrage pricing theory, APT, and the efficient market hypothesis, rely fundamentally on two variables, expected return and risk. This study investigates whether psychological states, specifically mood and depression, influence how investors perceive expected return and risk. We collected data from 717 Thai investors via the online survey. The study was supported by the Capital Market Development Fund, or CMDF, with the assistance in survey distribution from the Association of Thai Security Companies, or ASCO. Mood and depressive states were measured using standardized psychological instruments. The analytical approach involved both linear regression and logistic regression models to test the hypothesized relationships. Our finding indicates that positive mood is associated with higher perception of both expected return and risk. In contrast, negative mood lowered these perceptions. Moreover, elevated levels of depressive symptoms are associated with reduced perceived risk, particularly in the short term. Over the long term, negative emotional states are linked to lower probability of maintaining optimism toward risk. These results contribute to the behavioral finance literature by providing empirical evidence on how emotional and psychological factors can systematically influence financial perception. They also suggest that financial advisors and investment firms can enhance their services by integrating psychological assessment into client evaluations. Furthermore, the finding emphasized the importance of investor self-awareness, particularly in recognizing how emotional and depressive states may introduce systematic biases into the investment decision-making process.